Hello everyone. Today we are going to discuss about the equilibrium and types of variable assets in global financial management. So to begin with, let's know what is the meaning of a equilibrium. In general terms, it is a state of balance or stability where opposing forces or factors are equal in a magnitude and they cancel each other out, resulting in no net change or movement. Like it is a state where the balance or stability is facing the loss of magnitude because they cancel each other. It results in a constant movement or no change in the substitute. In financial terms, a equilibrium refers to a state where the supply and chain demand for a financial asset, such as a security, currency, balanced, and resulting in stable price, which means the supply and demand becomes constant, due to which the security or currency becomes balanced, in which it results as a stable price. The next one is what are the factors of a supply chain equilibrium? Supply equals demand. The number of players and sellers are equal, which who have cleared the stability. Next one is prices are stable. There is no tendency for price to change as the force of supply and demand are balanced. Next on this, no excess demand or supply. There will be no excess buyers or sellers in the market, so the demand and supply gets balanced out. Equilibrium price means the price at which the supply and demand curves and intersect. The equilibrium yield, the yield on a bond that equates the supply and demand. The next one is equilibrium exchange rate. The exchange rate at which the supply and demand for the currencies are balanced out. Many variable assets. But what is a variable asset? The asset whose value are written and is not fixed. It can fluctuate depending upon the various conditions of market and economic factors. A fixed asset value is fixed for a certain period of time and it declines by the market factors and also by the time, the years which has been in which the asset has been used. But in a variable asset, it is the value which can get fluctuated by the changing economic factors. There are types of variable assets such as stock. The first major example is stock. Equity shares in a company whose value can rise or fall depending upon the marketing shares and conditions. Although the stocks and shares gives the ownership to the individuals, but it also depends on the company's performance in the stock market, whether their share is getting the profit, gaining profit, or it is gaining loss. The next one is bonds. They are the debt securities which has the variable interest rates or credit risk. The debt securities, depending upon the companies, whether what interest rate they are going to fix on the debt. And these variable assets are those assets which can be liquidated in a short span of time, that is less than a year, such as stocks, bonds, mutual funds, and other securities. When compared to fixed assets, these are those assets which have a long term value and they cannot be liquidated in the market before a minimum time of 5 years. The third one is mutual funds. Again, they are also a short term in nature, and these investment portfolios are varying values based on the market performance. Depending upon the marketing conditions, their values changes. Next one is commodities. The physical goods like gold, oil, agricultural products with prices that can fluctuate. The commodities are nothing but fast moving consumer goods and also the assets which can play a major role but which can also be sold and liquidated easily in the nature. Currencies. The exchange rate that can fluctuate affecting the value of foreign currencies, such as dollar rate. A dollar rate keeps on fluctuating and it makes a major impact on the stock market. The next one is derivatives. Derivatives are those contracts such as option and future whose value depends upon an underlying asset, and these are also based on a short term or a long term depending upon the contract and contractors. The next one is real estate. Real estate means the value of land, building, or real estate value can be fluctuated depending upon the changing economic factors. The next one is alternative investments. These are the assets like art, collectibles, cryptocurrencies with uncertain values. Like cryptocurrency values gets changed over a period of time. So the alternative investments where a person can invest accept all the other alternatives which are readily available in the market, such as the art. Art means the pictures or the paintings which can be purchased and which can be resold. The index funds tracking a specific market index like the S&P, that is 500. The next one is exchange traded funds. The funds trading on an exchange with values fluctuating based on an underlying asset. The exchange traded funds are those funds whose value gets changed depending upon an underlying asset. The asset decides whether the investor gets profit or loss because as the market conditions change, the value of that asset change, and also the time period in which the asset has been utilized also impacts the profitability of the asset. These variable assets offer potential growth and they also carry risk, and their values can fluctuate over a period of time. So, here the equilibrium is the balance or a situation where it makes a balance out, it stays in a constant position where there are no change of movements and there are the variable assets whose values keeps on changing and fluctuating depending upon the market conditions, the economic factors, and also depending upon the foreign exchange rates. There are many investments which can be made in these assets who are interested in short-term liquidation, and they have the different types of assets such as stocks, mutual funds, and others, index funds, exchange traded funds, which provide the same benefit, and at the same time they provide the same loss to the investors. This is a overall summary of the presentation. Thank you so much for listening.